Hello and welcome to this week's edition of Mortgage Watch. I'm Ilan Awerbuch of Unitrust Mortgage in San Diego. This week, Goldman Sachs estimated that total subprime losses would total $480 billion before all is said and done. Only $120 billion has been recognized so far by banks and the Wall Street-related firms. So it makes you wonder what's really hiding out in the woodwork if there's 4 times as much losses to come. As we've said in previous weeks, though, because of the way accounting rules are now written, will the losses really be as great? The banks, Wall Street firms are having to recognize 100 cents on the dollar for losses, and in the end, this is all secured by real estate, and the losses are not going to be 100%. They're probably going to be, at worst, 50 cents on the dollar or something of that sort. So I think this thing is going to have some more bad news, and then it's going to flip around pretty quickly and kind of take a springboard off the trampoline. So, just stay tuned. It's going to take a few months, but again, it's all going to resolve itself, I think, in a pretty upward way. The Wall Street firms, they're investment banks. They're not depository institutions where people go and actually put their money in. And there's going to have to be something to be done to recognize that they are a growing force, or were a growing force, but that they don't really take in depositors' money. A lot of people are concerned about the offer that Chase made for Bear Stearns. The government is just trying to protect, everyone's money in the markets in general because of the influence of these Wall Street firms. This week, Chase upped its offer for Bear Stearns 5-fold to $10 a share. The board of Bear Stearns is really in favor of this, but the other shareholders are really against it, and that includes all of Bear Stearns' employees who control about 30% of its stock. So it makes you wonder what the board of Bear Stearns knows that's bad that the shareholders don't, because before this whole thing was announced very, very urgently about a week and a half ago, Bear Stearns was trading for $30 a share instead of $10 a share. So maybe there's a lot more bad news, or maybe they just figure they don't want to put everyone through the struggle of what a bankruptcy would mean for something like that. Also yesterday, KPMG, which is one of the giant accounting firms, was implicated in the collapse of New Century, the giant subprime lender based in Orange County that went down with a giant thud about a year ago that really started this ball rolling. It seems that senior management ignored obvious warning signs. Well, you think? These are giant accounting firms that are auditing all the affairs of New Century, and even though they can hide some things, it's obvious that they weren't able to hide everything. There's emails showing that the people on site were emailing the staff of the senior management of KPMG and letting them know that there's a lot of improprieties. And the senior manager was saying, well, we don't want to lose the accounts, so just be quiet. So we're all going to try and spell Enron once again because it looks like it's Enron all over again. In good news, the National Association of Realtors reported that February home sales were up by 3%, and that is very, very welcome news. It does seem, as we've said in recent weeks, that the housing prices have dropped to levels that serious buyers are out there looking. And if you are a serious buyer, you should be taking a serious look at what's out there. There are real deals out there, and of course mortgage rates are good. So we encourage everyone to take a look if you're at all interested in what's out there in the real estate market. There are definitely deals out there. The markets are in a lot better shape, the financial and credit markets, than they were in previous weeks. The Fed has been making a lot of moves, and it seems like the anti-anxiety medications are starting to take effect. Things are calming down. One way that we can measure this in real terms is the spread between Treasury bills, their interest rates, and the interest rates on mortgages. As we've said continuously, mortgage rates are not really connected to the moves that the Fed makes. But there is some relationship between them that's measured. And in previous years, the spreads between federal Treasury rates and mortgage rates were really much, much lower than they are now. They're about over 1% out of whack. But that's good news because as little as 2 or 3 weeks ago, they were 2.5% and 3% out of whack. So we're starting to see that contract, as we've said in previous weeks. We are looking for that to get down to where it was, and that will be a definite sign that things have calmed down and all the moves that the Fed is making are taking effect and that the markets are returning to normalcy. Again, the biggest problem is not the losses that banks have announced, but that investors have fled and are not buying mortgage paper as they used to. Mortgage paper is still considered safe, but A paper, Fannie Mae paper, and so on, and that's what the Feds are trying to get everyone to calm down. Well, now that the Feds are allowing the Wall Street investment banks to borrow money from them, the Feds, which really is all of us because the federal government is us, should there be more federal oversight of these institutions? Some people who are real advocates of a free market think that that's way too much, and that markets should just be allowed to do what they want to do. But as we're starting to see, it's all interconnected. It's really connected. It's connected worldwide. The last time I tuned into a football or basketball game, there were people running around in striped shirts who are refereeing the activity. So, you know, if we can have people refereeing football and soccer and basketball and even baseball with umpires, doesn't it stand to reason that somebody should be refereeing a Wall Street financial game? Because it affects all of us a lot more than the Super Bowl, the World Series, or the World Cup of soccer. So we're really, really advocating that the Feds take an oversight role and continue to help manage what's going on. They're not setting policy, but they're just kind of calming everyone down and doing what they should do, which is steering the ship in some way, which will get us into a safe landing. Well, that's your Mortgage Watch for this week, March 28th. We look forward to being in touch with you again next week. Thanks very much and have a great week. Bye.